Thank you, Kelly, and we appreciate you and the others at University Conference Services for inviting us to do this presentation today. Today's presentation will discuss why now is the time for pension plan sponsors to purchase annuities for some or all of their retirees. We're going to look at what has changed in the marketplace, how this will save your company significant money, and how to meet your fiduciary obligations, as well as why the right process matters. As Kelly mentioned, we are Michael and James from PSolve. This is Michael. I am based in our Denver office, credentialed actuary. James, I'll let you quickly introduce yourself so people can hear your voice as well.
Hi there, James Walton. I'm also an actuary, and I'm in our Walton office just outside of Boston.
Great. All right. So why are we talking about this today? So many sponsors feel that managing a pension plan has at least looked like the picture on the left on this slide. There's increasing fiduciary responsibilities and scrutiny from the government on payment practices, dealing in a low interest rate environment for a number of years now. We've had volatile markets. We've learned that people are living longer than what the mortality tables that had previously been used were projecting. And we've got rising administrative costs, the most significant being the premiums from the Pension Benefit Guaranty Corporation. Over the years, we've talked a lot about solutions to these problems, and today's webinar is going to hone in on one specific solution as it relates to transferring risk from the plan sponsor to another entity, and specifically, we're going to focus in on annuity purchases. So first of all, what is an annuity purchase? An annuity purchase is where an insurance company takes on the responsibility from you as the plan sponsor for payment of participant pensions. They'll do that in exchange for a premium up front. And what this means is, for example, if a plan has 1,000 participants and you purchase annuities for 200 of them, your ongoing obligation and responsibility is only for those remaining 800 participants in the plan. From a participant standpoint, really not much changes. Instead of getting their monthly check from you as the plan sponsor, they're now going to get it from the insurer that you've selected. The amount and the form of the payment, whether there's survivorship benefits, for example, won't change. Another maybe less visible change is the benefit guarantees that are provided. As long as a participant is in your plan, the Pension Benefit Guaranty Corporation is going to guarantee benefits up to a certain level. However, once an annuity is purchased, benefits are then guaranteed by the state insurance protections where that insurer does business. Today, we'll be talking about annuity purchases in context of primarily retirees, those that are currently receiving the monthly checks from you as the plan sponsor. So why are annuity purchases popular now? Well, there's really three big reasons, and we'll talk about each of these in depth. The first is rising PBGC costs. Over the last 5 years, we've had 3 updates to PBGC premiums resulting from legislation in the Moving Ahead for Progress in the 21st Century Act, the 2013 Bipartisan Budget Act, and the 2015 Bipartisan Budget Act. We're also seeing a lot more in terms of balance sheet consistency. The notion that annuity purchases are expensive compared to a pension plan balance sheet liability has all but disappeared. A lot of this is driven by the mortality table updates that have come out in the last couple of years from the Society of Actuaries and what that resulting impact has been on the balance sheet liability itself. Finally, administrative costs. Sponsors are taking note that they're paying a lot for participants with small annual benefits, and we'll get into some of those details later on in the presentation. So first, let's talk about PBGC premiums. So plan sponsors have seen substantial increases in their premiums over the last 5 years. We've shown for a sample client what those premiums have been since 2010 when this particular client was paying $185,000 in premiums up to 2016 when they were projected to pay $825,000 in PBGC premiums. Now, it's important to understand how these premiums are calculated. Premiums are made up of two components. First, we have the flat rate premium, which is a per participant head count premium, and you pay that on every single participant in the plan, whether they're a retiree that's collecting their monthly check, whether they're still actively employed at your company, or whether they have terminated employment, have a vested benefit, and haven't started receiving it yet. As you can see from the chart, the flat rate premium has almost doubled since 2012 and will quickly rise above $80 a head. Next, we have the variable rate premium. The variable rate premium, there's two components to it. First is based on a percentage of the underfunded PBGC liability. Back in 2012, that premium amount was calculated as 0.9% of any underfunded liability. That's risen to 3% in 2016 and will quickly get to over 4% in the next couple of years. Now, there is a cap on how much a plan sponsor pays in variable rate premiums. This is also tied back to head count. So, for example, in 2016, the variable rate premium cap was calculated as the number of participants in the plan times $500. If that amount was smaller than the percentage of underfunded PBGC liability premium, the sponsor gets to pay the lesser of those two amounts. So for plans that were at the cap or subject to the cap in 2016, PBGC premiums were essentially the $64 a head plus $500 a head in variable rate premiums, or $564 per participant, which, again, you can quickly see how this is going to go to over $600 per person in the next 2 years. So transferring participants out of the plan via an annuity purchase can save up to $600 per person per year on an ongoing basis. The next item, balance sheet consistency. So historically, annuity purchases have been prohibitively expensive. The reason was because the annuity purchase cost was more than the balance sheet liability. However, with new mortality tables that were published by the Society of Actuaries in October of 2014, that brought the balance sheet liability more in line with what the annuity purchase costs have historically been. We'll show examples of this later on in the presentation as well. But effectively, when we look at the cost of an annuity purchase for retirees specifically and compare that against the balance sheet liability that plan sponsors were holding, prior to the release of these new mortality tables, the gold standard mortality table, this RP 2000 scale AA mortality table, had about a 10 to 15% gap between what that balance sheet liability was and the cost of an annuity purchase. These new mortality tables have effectively eliminated that gap. You can see these new mortality tables, RP 2014, and we've shown two versions of it, the original version that came out in 2014 and the update in 2015. The new mortality tables essentially are reflecting what the insurers already knew about mortality experience, bringing now the balance sheet liability in line with the annuity purchase cost. The other point, the other reason why annuity purchases for retirees have become increasingly popular over the last couple of years is really due to the high cost of administration. The table that we are showing here shows the distribution of retirees by annual benefit amount for a sample client. And we've circled a group here because what we want to point out is that 80% of the retirees for this specific client have annual benefits below $10,000. When we look at the really small benefit people, those with annual benefits less than $1,000, the minimum PBGC cost that you could be paying, if you're just paying the head count, the flat rate premium, is extremely high at 8%. And if you're subject to the variable rate premium cap, the total PBGC premium can be upwards of 60% of the annual plan benefit. Even for those retirees with annual benefits of $10,000, you could be paying upwards of 6% of the annual benefit amount to the PBGC, just for the privilege of paying them their monthly check. And really, from an investment standpoint, when you think about the investment implications, you really cannot consistently out-earn that annual cost on top of the carrying cost, which you already have for these participants, which is around 3.5% to 4%. Now, in case you thought maybe we just cherry-picked an example there, we've put together a few other sample clients to show the distribution of their retirees as well. And really, we see this pattern of retiree benefit distributions all the time. In fact, 9 times out of 10, they look a lot like what we're showing for sample clients 1, 2, and 3. In these 3 additional examples, so sample client 1 is reflective of the table on the prior slide. For these 3 additional examples, client 2, 83% of all retirees in this group have annual benefits less than $10,000. For client 3, 89% of them have annual benefits less than $10,000. Now, client 4 has a little bit different distribution, primarily due to the fact that they had a richer benefit formula than the other 3 sample clients that we've shown. But even still, they have over 1/3 of their retirees with benefits that are less than $15,000. Now, we've circled some numbers in each of these columns. What that represents is these clients are ones that actually went through the process that we're going to talk about today in analyzing whether or not an annuity purchase for small annual benefit retirees made sense. And these 4 clients actually are going through or have gone through that process. And what we've circled is the amount of annuities that they've actually purchased for their retiree group. All right, so understanding why annuity purchases have become popular, we want to talk about what sponsors need to consider as far as an annuity purchase for their specific plan. So we've covered a lot of the reasons, right? Lower PBGC costs by virtue of getting people out of the plan, smaller plan liability going forward. We're going to reduce administrative costs, not just the PBGC costs, but as you well know, you're doing annual mailings for these people. So getting them off the books means no more mailings for them as well. You're also going to eliminate future mortality risks. So as an example, if suddenly there's a cure for cancer, that means people are going to live even longer, that would be reflected in your liability, that would drive it up. You're going to eliminate any future mortality risk that could come into play. All right, so what do you as a plan sponsor need to consider then? First, you need to understand what the impact on projected required contributions is going to be. You also need to understand what the balance sheet and P&L impacts are. And then you also need to understand what it means from a future purchasing power, doing an annuity purchase now versus if you're planning on terminating your plan within the next 2 to 3 years. And we'll talk about each of these on the subsequent slides. So first, cash flow considerations. So doing an annuity purchase may actually accelerate required contributions to the plan. Now, how much that ends up being and when those contributions hit will really depend on the size of the annuity purchase. Doing a small annuity purchase may not have as big of an impact as, say, doing one for all of your retirees or retirees with higher benefit amounts. Really what you have to do as a plan sponsor is weigh the balance between the additional cash that's going to go into the plan from these required contributions against the reduction of cash out of the plan in the form of decreased PBGC premiums. From an accounting standpoint, the main consideration is really going to be around settlement accounting. Settlement accounting is triggered in these type of situations and can result in an additional amount that would hit the P&L, recognizing net losses that are currently sitting out in AOCI. Now, if your company follows international accounting standards, you may actually see a settlement gain and actually get to reflect some additional income through the P&L by executing one of these annuity purchases. All right, so who should be looking at this? So if you've got a plan that has a large number of retirees, and by large number, 500 or more, you should be looking at an annuity purchase. If you've got a high concentration of small benefit retirees, you also should be looking at it, especially taking into consideration the administrative costs as a function of the annual benefits that you're paying out. If your plan is subject to the variable rate premium cap, you'll want to look at this. If you can absorb the short-term contribution increases, this will more than likely make sense as well. And really, where this is going to make a lot of sense is if you've got a realistic balance sheet. And what we mean by that is that your balance sheet liabilities are in line with the annuity purchase costs. And by that, we mean up-to-date mortality tables and discount rates that are based on yield curves similar to something like the Citigroup pension discount curve. All right, so to be fair, though, this isn't good for everyone. So if, for example, you have a frozen plan and you are working towards plan termination, and you're 2 to 3 years out from a full plan termination, this might not be a good de-risking exercise for you to consider. Going back to the point about purchasing power, you're probably better off keeping those participants in the plan for the next couple of years and being able to take a bigger annuity purchase out to the marketplace when you actually terminate. Now, if you have few retirees in your plan, there could still be a case to be made for purchasing annuities for some or all of those retirees, but generally, if you've got a plan with few retirees, there's usually a feature in the plan that allows participants to take a full lump sum upon termination. And if you've got a group like that where the majority of participants are electing lump sums, usually those that elect the annuity benefit tend to be the higher benefit retirees. Also, if you tend to have more aggressive assumptions for calculating your balance sheet liabilities, the economics on the accounting side might not work out as favorably as they would if you were using more market consistent rates, both on the discount rate side of things as well as mortality tables. And then lastly, if your plan is extremely poorly funded, this may not be an option for you. In order to execute on an annuity purchase strategy, you have to start with an adjusted funding target attainment percentage that's at least 80%. If you're not already there, you can make a contribution to get there, but if you're significantly underfunded, that may be a difficult amount to put into the plan. With that, I'm going to turn it over to James to talk us through the current annuity market activity.
Thanks, Michael. So let's look at the current market in terms of the insurance providers. There are 13 insurers present in the market, which I've listed on the slide. Many of those will be household names, such as MetLife and Prudential. Some won't be as familiar and are smaller insurers. But even the smallest of these companies have tens of billions of dollars of assets, as you need a degree of scale to achieve the required capital strength and to cover all the fixed costs associated with managing annuities. All these providers have been in the insurance industry for decades, but as we've labelled, there are some newer entrants to the pension annuity buyout market. Examples are One America and New York Life, who have re-entered the market. They previously did annuities but have re-entered recently. Legal & General are a big player in the UK and have recently entered the US market. And Securian entered in 2014. Voya was spun off from ING in 2013. So what I'm showing here is the historic annuity market activity in dollars placed, in billions of dollars, and I'm showing that through time. Rates were relatively low up until 2012, transacting at $1, $2, $3 billion each year. And then what happened in 2012, there were two particularly large transactions, General Motors and Verizon, which are shown in the coloured bars. But the reason those companies transacted were essentially the same reasons we're describing now, in that the price of annuitization was attractive versus the actual cost of holding these liabilities, and they wanted to reduce the risk. And then since 2012, we've seen transaction volumes gradually escalate. This is both an increased number of small plans annuitizing, but also a continuance of larger deals. So, for example, Motorola transacted around $4 billion in 2014, and we saw Philips and Kimberly-Clark transact in 2015, and there's been another couple of big transactions this year. The shaded component in 2016 is estimated. We only have hard data up to quarter two, but it's looking like we're on track for a year similar or exceeding 2015, which would be a record year if you strip out those two larger deals in 2012. So the summary here is that annuity purchase volumes have escalated, and we expect that to continue as plans mature. So moving on, what I'm showing now is the same chart, but just showing 2012 onwards. But here I'm showing the split of placements by quarter, which are the different coloured bars. And what's interesting here is that the majority of transactions by dollar amount tend to happen historically in the second half of the year, particularly in the final quarter. There's no particularly good reason to transact in the last quarter, except just to get the transaction through before the end of the year. And what we find is practically what seems to happen is the sponsor will kick off these discussions in Q1 or Q2. It takes some time to go through the process. The summer passes, and then you sort of transact in Q3 or Q4. And for that reason, we see insurers being very busy around this time of year, and we prefer to actually transact early on in the year, all else being equal. You should receive a slightly lower price in theory, as there should be more insurers able to devote time to your transaction. It's not so much we've seen bad pricing this time of year, but there's no reason you should wait to the end of the year, so why not get ahead of the rush? So what's happening in terms of current market activity and pricing? Well, in the deals that we're seeing retiree-only placements being very attractive to insurers, i.e. the price is low and it looks attractive to annuitize those people. It is possible to annuitize deferreds, but we see insurers feeling more comfortable taking on retiree liabilities, and there are a greater number of insurers bidding in that area of the market. I mentioned new entrants. We're seeing these players seek to be competitive to establish their businesses. So whilst demand for annuitization by plans has increased, as we saw in the chart, this seems to have been offset really by the increase in supply from insurers keen to access a growing market. I think that 2012 year really turned heads and was a big factor in some of those new players coming into the market. And of course, once you're in the market, you need to win business from the insurer perspective, and we're seeing prices come down for that reason. In terms of the actual the prices being achieved, we're seeing insurers bid at or below accounting values, as we'll see on the next slide. So what I'm showing here is a sample of transactions that we have advised on over the past year or so. And the percentages here in bold are the cost of the annuity placement divided by the accounting liability associated with those participants. And the recent transactions we've seen have all come in below 100%, which means the annuity premium the plan is paying is cheap relative to the accounting liability. Why has that been the case? Well, aside from general market competitiveness, I think these plans in particular have had smaller benefits, as and insurers can do that favourably if they think that the underlying worker is less well paid. And these are generally retiree-only transactions, which, as I've said, are attractive to insurers. So on that note, I'll hand back over to Michael, who'll talk about implementing an annuity purchase.
All right, thanks, James. So what we're going to talk through in this next section are the steps that you'll actually want to go through to make sure that you have a successful annuity purchase. So first off, we're going to talk about this in 5 stages. We're going to talk about data preparation and analysis. We're going to talk about understanding the financial implications for implementing an annuity purchase. We're going to talk about the strategic decisions at the plan sponsor level. And then James is going to actually walk through the insurer due diligence and the bid process to give you a sense as to what you'll go through from a due diligence standpoint in a fiduciary perspective. So first of all, preparing and understanding your data. Accurate data is going to lead to better pricing. Insurers look at many factors when they're underwriting the annuity purchase costs. They're going to look at the type of workers in the population, whether they're blue collar, white collar, some sort of mix. They're going to look at the size of the benefit. They're going to look at the age of the annuitants. And they're also going to look at where someone lives. And we'll talk about that more on the next slide to show you why that's actually important. So what this involves is really the insurers, when they are doing their underwriting, are taking a more detailed approach to valuing what the cost of providing this annuity benefit is than what your actuary is calculating for your balance sheet purposes. So gathering data to help the insurer understand the type of workers, the size of benefits, the age, and where the people live is going to help you get a better picture from a pricing perspective from the insurers. So that would mean things like gathering job titles, locations of where the people are currently living. Those type of data fields are going to be important to getting accurate pricing. Now, that could be a challenge as well because, again, remember that if we're doing this for retirees, it may be somewhat difficult to pull up their previous job titles from when they left. But having that information, again, will help the insurer understand the type of participants that you're purchasing annuities for. Now, when it comes to geography and where somebody lives, we're going to talk about why this matters. So this chart, what it shows is based on a few sample states, what the death rate is, or the number of deaths per 100,000 people in a given year. Right in the middle, we've got what the United States national average is, or 724.6 people per 100,000 deaths. You can see that Illinois and Idaho are fairly comparable when it comes to the national average. However, states like Mississippi, West Virginia, and Alabama can have death rates that are 25% or more higher than what the national average is. And then other states on the other side that can be about 10% or more lower, states like New York, California, and Hawaii. So understanding this type of information helps the insurer to more accurately price what the cost of the annuity is going to be. All right, next, understanding what the implications of an annuity purchase is going to be on the plan sponsor. So what we're going to do first is talk about the implications on accounting. And we talked about this a little bit before. First, on settlements. This is something that companies routinely look at and manage to in deciding what level of annuity purchase they want to transact on. Whether or not that settlement is important or not will largely determine the level of the annuity purchase. Understanding future contribution implications and reevaluating the investment strategy going forward, whether it's a re-risk or de-risk, will also be important. And then what the reductions to the PBGC costs and other administrative costs. Having an idea about what to expect from the insurers as far as their quotes is also going to be important leading into the actual due diligence and bid process. From our experience, using discount rates comparable to the Citigroup pension discount curve and valuing liabilities using some version of the new RP 2014 generational mortality tables are going to give you an accurate picture of where you can expect the insurer's best and final quotes to come in at. All right, and then finally, what are the strategic decisions that the plan sponsor has to make? You've gone through the analysis. You've more or less seen where there is benefit compared to the costs, and now you'll have to make some decisions, specifically on which group or groups of retirees to purchase annuities for, and then finally, what type of advisor to use to run the bid process that James is going to explain here in the next couple of slides. The type of advisors that you want to look at, you want to make sure that they've got experience and knowledge of the annuity marketplace. There's two main types of advisors that tend to help plan sponsors in this space. On one hand, you've got consultants, and the other hand, you've got brokers that tend to be more transactional. You'll also want to take note as to whether or not the consultant or broker that you're using is going to accept co-fiduciary responsibility with you as the plan sponsor in selecting the safest available annuity. And again, you'll want to make sure that they have knowledge not only of the annuity purchase itself, but what are the implications on the liability and investment side going forward. So with that, I'm going to flip it back over to James to actually walk through the due diligence process and the bid process.
Thanks, Michael. So the next step is insurer due diligence. Insurers are going to pay your participants for decades, so it's a good idea to ensure that they're sufficiently robust to be able to do that. However, apart from the fact that due diligence is a good thing, the selection of a provider is a fiduciary decision governed by ERISA. And the Department of Labour have issued guidance on that process that's referred to as 95-1 safest annuity available. And what those guidelines essentially say is that fiduciaries shouldn't just select solely on price, but should take steps to ensure the annuity is secure and appropriate for the participants. So I've copied the wording here from the guidelines, which I'll paraphrase. Fiduciaries must conduct an objective, thorough and analytical search. They must evaluate a number of factors relating to annuity providers' claims paying ability and creditworthiness. And reliance on ratings, credit ratings, isn't sufficient to meet this requirement on its own. The other important thing with these guidelines is that although fiduciaries are expected to choose the safest available annuity, the guidelines do state, and I've highlighted it in bold, that more than one provider is able to offer the safest annuity available. So what happens in practice is that most, if not all, of the insurers on the list that we showed earlier can be deemed safest annuity available. If they weren't, they wouldn't be in business and they wouldn't be on the list. However, it's still important to go through the process, not just as a box-ticking exercise, but as good practice in the event an insurer does deteriorate, so it would catch that. Also, in some cases, it may be there are features of the plan or the participants being annuitized that mean a particular insurer is less suitable in this case. So just to expand a bit more on what the due diligence involves, typically your advisor will present due diligence on the insurers covering a number of areas that are mentioned explicitly in the guidelines. And those are listed here, and they're really centered around the insurer's strength. So their investment portfolio, their size, their level of capital and surplus, how diversified their business lines are, and any exposure to liabilities that the insurer may have. And then it'll also cover the details of the annuity contract you're entering into and the level of state guarantees that participants will enjoy when they're with that particular insurer. Generally, that's not really a differentiating factor, as it's based on the location of the participants or policyholders as they will become. We'll then look at other considerations as well, which aren't explicitly mentioned in the guidelines, which may influence the decision. So service levels, the level of support the participants will experience, and also our own experience with the providers can also have a bearing, and perhaps name recognition might be important to some policyholders. Those are all factors which may weigh in on the decision in addition to price. So moving on from the due diligence, we'll now get to the exciting bit, which is actually to run a bid process and to solicit bids from insurers and ultimately to close the transaction. So we've refined our list of insurers and we'll solicit bids from them and send them data. And we think it's really important to be credible and consistent with the insurers in this process. Some advisors will ask for bids just to fish for prices because they're interested in where annuity prices are with no intention of transacting. If an insurer doesn't believe that a bid will actually result in a transaction, they may not take the bid seriously, and you'll receive a higher price for that. Pretty much all our bids, I think, have resulted in transactions. We think it's important to go in and give confidence that a transaction will close. And insurers are also busy quoting. and they'll prefer to devote their time, to a transaction they'll think they can win, and they'll want to work with an intermediary who they've had good professional experiences with. The other factor is timing throughout the year, which I've mentioned. Q1 and Q2 are less busy times for insurers, so we prefer to transact then. But there is a deadline, at the end of the year if you are transacting later on in the year, which you'll want to hit in order to reduce the next year's PBGC premiums. And then typically a bid process will run over a couple of stages, and there'll be a final bid date where you'll line up all the insurer bids, and you'll select the final insurer. That process will involve, once you've selected them, wiring them the money to pay the premium, and then at that point the annuity transaction is closed and the liabilities are off the books. It's also possible to pay rather than with cash, with assets in kind, just to transfer assets that you already own, which we see as an increasingly common thing amongst plans. And then post-transaction, as Michael mentioned, there may be other issues you might need to revisit. The investment portfolio may need rebalancing, but that's really a separate decision following the close of the annuity transaction. So that completes the annuity process. I'll hand back over to Michael to go through a case study.
Excellent. Thanks, James. So what we're going to do, we're going to walk through two specific case studies for two companies that both went through the steps that we've outlined in today's presentation. First, we'll look at company ABC. This sponsor maintains a mostly frozen pension plan. They have a small active group that continues to accrue benefits. You can see their participant counts as of the beginning of this year. They had 277 active participants still in the plan. Most of those have frozen benefits, and as I mentioned, some still have benefit accruals. They have 577 vested terminated participants, so these are people that are due future benefits but don't currently work for the company anymore. And then finally, they have 1,251 current in-pay retirees, so a group that they're cutting the monthly check for, and then the total being just over 2,100 total participants in the plan. So one of the first things that we looked at was what is their PBGC, their PBGC premium costs, and specifically the variable rate premium. This particular company was not subject to the variable rate premium cap in 2016. Their PBGC liability was just over $132 million. Their assets, $115 million. So their shortfall, their underfunded PBGC liability was about $17.5 million. So their variable rate premium before reflecting the cap ends up being, for 2016, 3% of that $17.5 million, or an amount just shy of $525,000. The cap amount for this particular company would have been that $2,100 multiplied by the $500 cap for 2016, or an amount just over $1 million. So the cap clearly does not come into play here, since the variable rate premium was just over $500,000. So again, we started by looking at the distribution of their retirees. They have a significant number of retirees, like we mentioned before. That makes them a good candidate to look at an annuity purchase. They also have a high concentration of low benefit retirees. And in fact, for them, 85% of their retiree population have annual benefits that are less than $10,000. That number jumps up to 94% when you look at the total number of retirees with annual benefits less than $20,000. The group with less than $20,000 in annual benefits, while it represents 94% of the total retiree population, actually only represents 65% of the total retiree liability. So this plan sponsor honed in on two subsets of the retiree population to start with. They looked at the group with benefits less than $10,000 and the group with annual benefits less than $20,000. They compared their PBGC premium savings against the increase in required contributions if they were to purchase annuities for these two groups. And as you can see, For the under 10,000 group, the present value of just the first 5 years of PBGC premiums amounted to $2.2 million, while the increase in contributions over that same period of time was $1.9 million, or an 8% increase above what they would have expected to pay without doing an annuity purchase. For the under $20,000 group, the present value of the next 5 years worth of PBGC premiums was only $2.4 million compared to an increase of $3.5 million in contributions. Ultimately, this company decided to purchase annuities for the group with less than $15,000 in annual benefits. So we ran through the bid process as James explained it, and the annuity purchase price for this particular case came out at 95% of their accounting liability. Now, this particular sponsor happened to follow international accounting standards, so the accounting implication for them from a P&L standpoint was to actually recognize a settlement gain or additional income through their P&L by virtue of enacting this annuity purchase for the group of retirees with annual benefits of less than $15,000. All right, another example. So we'll call this one Company XYZ. This company maintains a completely frozen pension plan. Their counts as of the beginning of January 2015 are there on the screen: 100 active participants, 850 vested terminated participants, and 520 retirees, or a total population just shy of 1,500 participants. Now, this plan was subject to the variable rate premium cap in 2015. Their PBGC liability was just shy of $88 million, assets just shy of $62 million, their total shortfall of $25.9 million. The variable rate premium before reflecting the cap, and again this is in 2015 when the variable rate premium was 2.4% of that $25.9 million, came out to be $621,000. Now, reflecting the cap is based on the total participant count, or 1,470 participants, times the cap amount for 2015, which was $418, or $614,000 it was the capped variable rate premium. Since that amount ends up less than the 2.4% of the underfunded PBGC liability of $621,000, the company would pay that smaller amount, that $614,000. So again, a very similar process here, where the company started by looking at the distribution of their retirees. In this particular case, 80% of their retirees had annual benefits which were $10,000 or less. They also represented only 40% of the total retiree liability and 20% of the total plan liability. So the company went through the same analytical process that we described earlier, looking at what the impact would be on their cash costs in the future, what the P&L impact would be, and what their balance sheet impacts would be, and ultimately decided to purchase annuities for the group with annual benefits of less than $10,000. Similar to the prior case study that we looked at, the annuity purchase price for this group came in at 95% of the balance sheet liability as well. Now, this company doesn't follow international accounting standards. They do follow the U.S. GAAP standards, and subsequently had to recognize a settlement expense in the P&L this year, recognizing a certain portion of the net losses that were sitting out there in AOCI. But again, through the analysis process, they felt comfortable with the amount that they would have to run through the P&L, and decided that the cost savings in PBGC premiums compared to the increase in cash costs and the impact to their 2015 P&L, that it still made economic sense for them to go through with this transaction. As far as their projected PBGC costs, you can see what this chart shows is their historical costs that's for the 2010 and 2011 were below $200,000, which then incrementally increased up to 2015, where they were paying $700,000 in total PBGC costs. Those were, if they didn't do an annuity purchase, those costs were projected to increase close to $900,000 by the 2019 plan year. By affecting this annuity purchase for annual benefits, for retirees with annual benefits of less than $10,000, just in PBGC premium savings alone, the total savings amounts to $1 million in just the first 4 years. Now, those savings would potentially go on, or theoretically go on past 2019 for as long as those participants would have been drawing benefits from the plan itself. One item that I will comment on before we open it up for questions, one of the differentiating factors between an annuity purchase as a risk transfer exercise compared to a lump sum cash out window is that with the lump sum cash out window, you can't force people to take the lump sum. It's very, you send distribution packages out, you might have a communication strategy, but ultimately the amount of vested terminated participants that you could cash out is going to be highly contingent on people's response rates. And what we see is typically those response rates tend to be around 50% if you've got a good lump sum cash out window. The difference between that process and an annuity purchase, as we've described it today, is that with the annuity purchase, you have full control over who you purchase annuities for. So you can decide what subgroups to purchase annuities for. There's nothing that the participant can do or say that can prevent you from going out and purchasing that annuity. So you, as a plan sponsor, you have much more control from a risk transfer standpoint in affecting an annuity purchase compared to a lump sum cash out window. Now the economics may be different, but as what we've hopefully shown you today is that they still can be compelling with an annuity purchase. And with that, Kelly, I think we've wrapped up our part of the presentation and are ready to answer any questions that may have come in.
Okay, wonderful. Thank you, Michael. Again, any participants who do have questions, please go ahead, type them in on the Q&A pane at the bottom of your screen. We do have one question that's come in so far, and it reads, what is the timeline for completing an annuity purchase, and how much involvement is required from plan sponsors?
Sure. So let's tackle the timeline first. As James mentioned, going through the due diligence process and doing the analysis up front to make sure your data is prepared and that you understand the financial implications. We've had plan sponsors that have been able to go through this process in as short as 3 months. Sometimes that means an abbreviated analysis or perhaps an accelerated bid process. But I think the shortest we've seen is 3 months. I think what we typically would see is somewhere in that 3 to 6 month range by the time the plan sponsor has gathered the data, been able to maybe dig into some of those other fields that we discussed, run the analysis on the cash contribution impacts, the accounting impacts, the PBGC and other administrative cost savings, figuring out where they're going to draw the line, and then how they're going to run the bid process using a consultant or another advisor. 6 months, I think, is probably provides the most amount of time for a plan sponsor to make a really informed decision and really understand all the ins and outs of the consequences of the annuity purchase, and also to allow for the insurers ample time to go through their underwriting process, understand the plan, its provisions, the demographics, and to be able to provide accurate pricing. James, anything else that you'd say from a timeline perspective?
No, I think that's right. I mean, I think the bulk of the work on the sponsor side is just the preparation, of the data and kind of understanding that analysis. I described the due diligence and the bid process, but that's really just a case of a few governance meetings where your advisor would present that work.
And then going to the other part of that question, Kelly, what is the time commitment from the plan sponsor perspective? A lot of that is going to be up front in collecting that data, digging up any of those additional fields that may be helpful to the insurer in providing accurate pricing as far as demographics and the type of workers that you're purchasing annuities for. So a little bit of upfront work getting that data file ready to go. But then, I think most plan sponsors are going to rely on their consultants to help them understand the cash and cost savings analysis, as well as kind of the ongoing investment strategies after effectuating an annuity purchase. So a little bit of involvement up front, and then, I would say probably 2 to 3 meetings to sit down with the advisor to figure out where you're going to draw the line for purchasing annuities, and then, as James mentioned, actually walking through the due diligence with the advisor, deciding which insurers to provide best and final bids to, and then finally reviewing those best and final bids and executing on the transaction. When you actually execute on the transaction, a lot of that will be handled by the trustee or custodian, transferring those assets from the plan into or to the insurer. And then, there may be some data questions and cleanup that potentially happens as part of the transition and implementation process, but from a plan sponsor perspective, the time commitment tends to be very low.
Okay, thank you. We do have another question that's come in. It states, should the level of interest rates be considered when to do a pension risk transfer?
James, do you want to take that, or do you want me to?
Yeah, no, I can take that. It's a good question. So as interest rates move, the price that annuity providers will quote will also move, as will your accounting liability. And what you should see is that your accounting liability will move in line or very closely to that price that the insurers quote. So in terms of the accounting impact, there shouldn't really be much difference as interest rates move around. The second consideration is on the investment side. If you're going to pay for this transaction out of bonds or treasuries that are already matching liabilities, again, the value of those bonds and treasuries will move up and down with interest rates in a similar way to the annuity price and to your accounting value. So again, it doesn't really make much difference in terms of the affordability as interest rates move. But in summary, essentially, what you're doing when you're buying an annuity is from a rate perspective, you're buying bonds to back your liabilities. If you already own those bonds in the first place, there will be no net effect. If you don't already own them, then you'll be effectively locking into interest rates at the point in time that you're transacting.
So James, is it safe to say then that companies that have already bought into the investment strategy of liability-driven investing, doing an annuity purchase for these small annual benefit retirees is more or less an extension of that? It's just a permanent basis that removes the risk from the plan sponsor in total, as opposed to maintaining that risk and potentially having those administrative costs reside with the plan sponsor.
Yeah, that's exactly right. If you already are using bonds to back your liabilities, then you've already immunized against interest rates, and the annuity transaction is really just transferring that extra longevity risk and removing the administration costs, etc.
Okay, excellent information, gentlemen. Thank you so much. This has been an excellent presentation, and ladies and gentlemen, thank you for participating today in our webinar. I hope that you'll join us at one of our conferences in 2017, where you can meet Michael Clark in person, and maybe James, you'll be joining us as well at some of the locations in 2017. We're thrilled to have PSolve as a sponsor. And with that, I think we will wrap it up for today. And gentlemen, will you be sending your slides to the attendees tomorrow so that they can contact you individually with questions?
Absolutely, we can definitely do that.
Perfect. Well, again, thank you all. Thanks for an excellent presentation, Michael and James. And hope everyone has a great afternoon. And if you would, fill out a short 5-question survey when the webinar concludes. We would really appreciate it. Thank you. Bye-bye.